Imagine a 2.5 million capital gain from your business, real estate, or stock sale hitting your return. With the IRS eyeing $1 million slice, what if the market's daily up and downs could generate offsetting losses on demand, pre or post event? While you are able to capture the returns of your market portfolio, that's the edge of market-based strategies like long-short overlays and direct indexing. If you're facing a gain or planning one, this is how to turn volatility into your tax equalizer. Hi, I'm Logan Smith, Chief Investment Officer at Horizon Wealth Tax Strategies. You can turn market volatility into your secret weapon with strategies like the long-short overlay and direct indexing. These market-based solutions generate losses to offset gains, whether pre or post-event, without locking you into liquidity traps. Today, I'll walk through how they work, why long-short is our go-to for bigger impact, and how to deploy them. Market-based tax solutions are all about using public securities to create offsets on demand, keeping them flexible, liquid, and fully compliant. We lean towards long-short overlays for their power to deliver consistent market returns while capturing substantial paper losses. With direct indexing offering a gentler entry for those who prefer more gradual plays or face smaller liabilities. Both fit seamlessly into pre-event planning or post-gain cleanup, ensuring your portfolio stays diversified while the IRS gets sidelined. Let's start with the long-short overlay, our preferred tool for high-impact offsets. Imagine your core portfolio, say $5 million from a recent sale, sitting secure and earning as planned. We then layer a margin overlay by borrowing against it to go simultaneously long on rising stocks and short on falling ones. This creates a risk-neutralizing balance while you're playing both sides of the market at once and netting near zero exposure to overall swings on the overlay. When a position dips, we harvest the loss from the losing side by closing it to realize the offset, while leaving the winner unrealized so it can keep growing. The beauty lies in generating losses with controlled downside risk, up to 92% of your funding in a single year. In other words, we could potentially harvest $4.6 million in passive losses from that $5 million initial collateral, all while capturing the returns on the initial $5 million exactly as originally planned. It's compliant with IRS wash sale rules through unrelated securities, all in liquid public markets. Now take direct indexing. On the other hand, is a steady builder for those wanting hands-off harvesting. You own the underlying stock of an index like the S&P 500 directly, selling underperformers for losses, averaging about 10% annually, and swapping similar ones to avoid wash sales. It's slower than long-short and fades in bull markets after 3 to 5 years, but ideal for conservative post-sale tweaking without all the leverage. Both keep you invested, not sidelined, preparing for future events or cleanup tax liabilities. The market's wild ride doesn't have to derail your wealth. It can be the engine that powers your tax freedom. Thanks for riding along with me today. If this flipped your thinking on tax loss offsets, grab the full ebook at hwtrackstrategies.com for the full playbook, or give our team a call. Our crew custom builds your market edge: reduce, defer, mitigate, eliminate. Side by side, we'll turn volatility into victory. Your horizon is not just calling, it's yours to command.